In this video, we're going to look at the bull trap trading strategy in Forex. Stay tuned. Hey traders, a very warm welcome to you. Okay, so the bull trap, one of my favorite kind of trading strategies. I have to admit, on a shorter time frame, but I want to cover it in this video on a longer time frame so you can see the premise, you can see the thesis, and if you want to tighten up onto a day trading strategy, by all means, I think you're good to go. And also I'm going to focus purely on currencies in this video because I find that it occurs a lot in Forex. I don't know why that is the case, but it just does. Maybe it's because we're picking charts that suit the strategy, which is obviously the point of a strategy. You find the market conditions that suit the strategy, but it just seems to work well. So let's get stuck in. Let's look at exactly what it's all about. So the idea of the bull trap is that you're ultimately doing exactly that. You are trapping buyers. You are looking at price action which suggests that price is going higher, enticing in buyers only to reverse quite sharply, have them get caught out, and then utilize their stop losses and their selling momentum to make money on the short side. So it's a going against the crowd strategy. Now, you'll see in a minute how it's why I like it a lot is because you can define your risk very, very specifically. And the risk rewards when it sets up can be phenomenal. It can be a really good strategy. Okay, let's talk through it. So we have, for example, a high put in here. The price then pushes lower. The price then pushes back to high. And very quickly, intraday or kind of, very short time frame, if you're on an hourly chart, you don't want it too long, you want it as quick as possible, it rejects that and pushes back under that high. The theory being that that high point there has sucked in a lot of buyers who are buying the breakout, who have kind of seen this chart pattern coming to play. They think it's a reversal or they think it's a continuation, whatever it may be, and they've just been rejected very, very quickly. And that's the key to it, is the quick rejection. And if you have a look here on US dollar CAD, a daily chart, I'm going to stick a horizontal line in here. You can see we just poked above. Let me drag it down a little bit for you guys. You can just see we just poked above that high. So the high there was 135 at 885, and then the high here was 135.985. So just enough. Okay. Again, we're not cherry picking strategies, and maybe in a perfect world we want this kind of wick a little bit higher to the upside. Obviously the higher the better. In actual fact, the more steep, if you think about this on an intraday basis, that's going to be that shape intraday, pushing to highs and failing and really changing direction intraday. So the higher it goes, the more people are trapped. So the bigger this wick intraday, the better. But you know what, we'll take that if it's 50 pips, 20 pips, whatever. We can work with it because this is the beauty of the strategy. Let me clear off some of this stuff. Is that the way you do it is you say to yourself, okay, I'm going to use it. Get the line back out again. We don't lose that. We're going to, there it is, we're going to use the high as a stop. So in this example here on US dollar CAD daily chart, we see this little bull trap set up. Now what you also want to see is you want to see that bearish candlestick. So you want to see the kind of thick red body, the push to the upside, the wick, the stuff. Familiarize yourself with some of those bearish candlesticks that are suggesting higher price but then changing intraday. So we see that we're going traditionally, you know what, you can adjust this and tweak this, but traditionally people are going to say, okay, I'm going to go short on the break of the low side of the trigger candle. So we push above the high, that's phase one. We go now below the low, we close, and then we look to trade below the low of the candle that triggered that above the high, if that makes sense. So we're triggering our short here, and our stop is going to be above the high that candle made. So it's a very quantified risk trade, which is why I like it. Because any trade for me that I can look at and say I can have a go at that. If the premise is wrong, here's exactly where my stop is. There's no ambiguity to it. If this trade is right, and if it is a bull trap, it's not going to revisit that highs, is it? The whole thesis behind the trade is that people are trapped in it, caught, they chase the high, they've got caught out, they've got to trigger those stop losses and sell into that move to the downside. And if that doesn't happen, if it pushes back to highs, negated, you want out. So you're getting very serious risk reward ratios. I mean, in this example here, you're going low, so you're going short as it breaks the low there and you're high there. It's not a lot of risk compared to, you know, the size of the gains when you're right. And okay, this is a decent example in terms of the gains. The clarity of the signal could be better, but it's good enough. We'll look at another example in a second. The point is risk reward ratio becomes very, very high, because you often get this at the end of trends as well, guys, pushing up. People think it's just another pullback, and then it just slams to lows. Now, some people will take a short on the kind of break of this low here. I think that's a little bit late in the day. I prefer to do it early, get stopped out multiple times, but when I get on the end of one, I'm getting 10, 20 times my reward back. Again, we've got one here, US dollar JPY, and you can see there's loads of little mini ones, and actually even back on CAD, US dollar CAD, there's loads of little mini ones where you're getting spikes to highs and breaking. You know, this is a bull trap here. You know, it's not as clear as the trend and the big move, but you know, it's caught people out. A lot of people got sucked in on that high, been rejected, slammed to lows. Great opportunity for you if you're looking for that. Again, here's a bit more of a clearer one. There's the high, we break to high, you get that bearish candlestick pattern and then slam to lows. Breaks through that low, the next day take it. Your risk is that, without making this chart too messy, your reward is very, very high. So that's the bullish trap pattern. It's a good little pattern to do. It's nice because you can quantify your risk. It's nice because the risk reward ratio is high. Doesn't happen very often. It's popular on a daily chart. I think you can also use it on a short time frame as well if you're quick on the ball, as long as it's not too short and you're doing it in no man's land in chop. There's no point in trading it when you're just in chop, because you know, price could go anywhere. But when in the right conditions, nice little trade to take. Anyway, comments below, guys, if you trade this strategy yourself. If you like the video, give it a thumbs up, and don't forget to subscribe for more videos from me and other traders on this channel. Take care. Bye bye.